Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, July 10th, 2026. It is 10:58 a.m. Eastern Time as I'm starting the video, so we're about an hour and a half into the trading day. Here's what we're going to do in this one. We'll keep it relatively brief. I'm going to go over, as I like to do from time to time, just catch up on some of the questions on the homepage. I already answered, got to that one in the last video yesterday. I was around. I just didn't see anything worth noting. Keep in mind, I'm just going to reiterate, we're still on the back end of the 4th of July or Independence Day doldrums in the U.S. markets, where just about everybody and their brothers on vacation around this time of year, taking time off from work. I'm not traveling, but I'm just not seeing a lot right now. We're also, if you've noticed, the recent theme has been more of a lot of our existing trades hitting one or more of the price targets, in many cases the final price targets. So I get it if you're maybe new to the site or you're looking for new trade ideas. I haven't been hunting that much, and I do look every day. Don't get me wrong. I look at dozens of charts. I'm not seeing a lot that stands out and that excites me. But every now and then, what I'll do is a deep dive. I'll kind of do a reset, take a look at new sectors, global markets, commodities. There's always something out there. But being that we've been around the doldrums, like I said, it's typically the week before and the week after the Independence Day holiday. Trading volumes are light, whipsaws are increased. I just want to let you know that I will be turning my focus no later than the start of next week, if not tomorrow, to hunting and finding some new trade setups, new trade ideas, especially as we're closing out, hitting some of the final price targets on a lot of these trades, or the higher up, you can see down here. So, like I said, it's been a stock pickers market. If you go back, there was a video I did in the beginning of the year. I made that prediction as well. It was also a stock pickers market towards the end of last year, meaning the markets have gone nowhere. We'll get to the indexes in a second. So here's what we're going to do, guys. Okay, so new trade ideas will be coming. At least, if I can find them. I never, ever force a trade, nor do I ever force post trade setups or ideas on the site if I don't think that they're worthy. In other words, just like in real estate, they say the most important three things are location, location, location. When you run a website, it's content, content, content. First of all, I don't do any SEO. I've long since closed down. I don't do the public YouTube channel. I don't do social media. Just word of mouth. I do this because this is my hobby, my passion. I don't advertise. I've never paid a penny to Google or any of the search engines, so I don't care about the where I'm going with the SEO part. Content, content, content. That is, if you do run a website or social media, whatever you call it, Instagram, one of those, that's what you're supposed to do, is constant content to your subscribers to increase, hits on your channel and all that. So again, if you understand where I'm going with that, is I'm not going to give you trade ideas for the sake of just giving you, somebody signs up, oh, I thought I'd get 15, 10, 15, 20 trade ideas a week. No. If you followed me for a while, and you're welcome to reach out to others in the trading room or the comment section, you can privately contact people via the trading room if you're a gold member. What'll happen is, when I find a sector, an index, or even if the market or a particular commodity all of a sudden is really setting up nice, with a lot of potential, I'll be all over that like white on rice, pumping out videos covering multiple trade ideas. And that's what I'll usually do if I find a sector with a lot of promise, whether it's bullish or bearish. I'll usually go through the sector ETF, cover the individual components, and kind of give you that as either a shotgun approach if you want an individual stock pick. And in some cases, some of the sectors I come across, they don't have specific ETFs for. Not every sector has one. All right, let's dive into the charts. Here's what we're going to do. We're going to catch up on customer, subscriber questions, comments. I already answered these. So that was a couple days ago. Somebody asked the update on GDX. I gave you an extensive update on the miners in that video day before yesterday. That'd be Tuesday. So we're just going to go catch up here. We're caught up to all the questions. There's a couple new ones here. Somebody asked me about my thoughts on FFIV. If you're interested, this was yesterday. I gave you the chart there. Um, and again, my thoughts. I don't have a super strong convictions or a great read on it. Like I said, no sell signals at this time. Although I did give you a wedge. Let me check on that one because I didn't set an alert. That's not the chart. We're going to get to that weekly chart in a second. FFIV. I'm curious myself. Yeah. So there it is. So. That's a bearish rising wedge, but that isn't. There are two types of trades, if you will. A trade setup, which is a potential trade, just that has the potential to be a long or short trade setting up in a pattern. And then what you need is a catalyst, which on a bearish rising wedge, it's a breakdown. There was a breakdown there in FFIV, ended with a bullish falling wedge at support, beautiful gap resistance, and a breakout. So those are your catalysts. So again, this is that in reverse. This is a bearish rising wedge with a sell signal coming to break of that trend line. And you can see in that, give you a couple targets on that one if you're interested. So all you do is, I don't know if I already did it. I can do it again, set an alert. And that's it. If you get the price alert, boom, you go. All right, back to the site. Let's see. That's FFIV. Someone just making a short-term prediction whether the market will be up or down. Somebody asked me about KMB. It's a great question. Nice call on KMB. Will the drop, with the drop in the price after you hit your target, I'm thinking it might be a good candidate to accumulate for the longer term. Any thoughts? Okay, a lot of thoughts there. So remember, I've been persistently and consistently bullish on the packaged food sector, but selectively select stocks, not all. They're a subsector of the consumer staples. They're defensive issue companies. You're still going to eat your cornflakes, during a recession, or if that's your cereal of choice, just using the example, and you're still going to buy paper towels and toilet paper and all that stuff. So those stocks tend to hold up better. Their business models are steady Eddie. Yeah, their sales can ebb and flow depending on what they got going on with products, competition. But again, they're called blue chip stocks, diversified, they've been around, they pay dividends. And now, with that being said, I want to just get this out there. I'm going to go over some long-term indicators and even sell signals pending in the markets. Remember, all ships are lifted with a rising tide, is one of the sayings in Wall Street. It's not literal, but it's metaphoric. In a bull market, most stocks will rise. Although that hasn't been the case here. We're going to get to one of my breadth indicators in a second. It's funny I say that. I had no intention of. But and then conversely, I like to say when the tide goes out, most ships fall. So what happens is you just have relative outperformance, and that is if you get a broad-based sell-off. Now, keep in mind, as I said in the beginning of this video, I said in the beginning of this year, I said it last year, towards the last half of the year, and we did it. It's been a stock picker's market. We've vastly outperformed. If you look at the picks collectively, including those that didn't pan out, vastly outperform the performance of the stock market because we're getting that sector and stock rotation very, very much. So index funds are kind of just slogging around, especially in the last few months, the major indexes. But, any given week, any given day, or, a little what I call micro trends, you see money rotate in and out of different sectors and subsectors. So that's what we call a stock picker's market. If you put a little bit of time and effort into it, and manage your trades. And I know some of you might just want the easy thing and put my money. Do I go long or short the market, or do I go long and short gold? Well, all of those are just one part of a diversified portfolio. Any, gold, if you're going to trade the indexes, or any other commodities. And, the thing is, whatever you do, just I love OCO orders. I think it's the best thing to come to the financial markets, the best invention since sliced bread. It means you enter your position, have a trading plan. What are you going to buy? Why are you going to buy it? Where are you going to buy it? That's what I give you here, my thoughts. And then you take it. You set two orders immediately after that, an OCO. Your one is your closing order. If it's a long trade, that's a sell limit order at your limit where you want to sell it, at your profit target. And the other is a stop loss order. And you make sure they're set good to cancel and tied in together as OCO. Some brokerages call them OCA. One cancels another instead of one cancels the other. Same order. and that's it. You set it and forget it. And that's a way you can easily manage a portfolio of a dozen or more positions, because it's turnkey. And what it does, the other than the convenience that you can then go take a vacation, not be in front of your computer for a few days, few weeks, whatever you want. It's the other thing there is discipline, and that's where I find over the years, and believe me, I've learned over the years myself. I've suffered from this. A lot of traders don't have the discipline to stick with a trading plan, um, and so by doing that, the OCOs set it and forget it. Unless something compelling in the charts convinces you otherwise that you should modify your trading plan, just leave it alone. And then one of two things are going to happen: your price target's going to be hit, and then it'll cancel the stop loss order for you automatically, or your stop will be hit, and that's it. And there's that discipline that most lack on the. It's on both sides. I've noticed over the years, a lot of retail traders, they let the losers run too long beyond their initial stop plan, or after a series of a few losses, they get a winner. The winner starts to go. Maybe it's something on this site. Maybe it's something you picked on your own. You were looking for 30, 40%, profit potential, but you get a quick 10%, and it's the first green you've seen in a while. And what do? You take profits. And then so that's the opposite of what you should be doing in investing and trading is let your winners run, cut your losers. And so when you know, doing that. So again, that's so OCOs, if nothing else, give you that discipline. All right. So okay. So let's get back to KMB. Here's my thoughts. Okay. So as you know, and this was just recently, we hit the final target. T3 was my final target. I'll get to the chart in a second. And we got, as expected, a final target is where I believe that the risk reward is no longer favorable for staying long. It's where likely you're going to get a reaction, and in many cases, and proves to be the end of the trend, whether it's a long trade, or it's the end of the uptrend, or a downtrend, at least before a meaningful reversal. So now, the way it works is, remember, in technical analysis, this isn't something I made up. It's just how technical analysis works. Resistance, which are my price targets, once broken, then becomes support. So, in other words, on Kimberly-Clark, which hit T3, our final target, T2 would be the first support level. That's the price target below T3. Then, as would any pullback to T1, which also comes in with the intersecting 200-day moving averages. And as I said here, that's a better re-entry point, in my opinion, if we get it. Now, you may not get it. You don't always get what you want. So my reply to this is, me personally, I wouldn't re-enter KMB yet. That could be it. I'll show you. It already hit T1 and bounced from there. They stepped in and bought it, but not by much. Now, so here's what I see in the chart when I look at the chart. So this isn't just we hit my final target, so that's it. No, what I see is this high-level bearish PPO crossover. Here, I'll show you the chart. Let's just click it here. Okay, so this was it. Potential is just that. Unless I eliminate the word potential, make that an official target, that was a potential target that I saw when we entered the stock way back, wherever it was, back here. I think we bought this one off support here, pre-breakout. You can look it up. So I see a couple things in the chart. I see what I call a high level, very high level. That's about as high as a PPO gets, if not higher in years. And it's crossing down, making a bearish PPO crossover. So that's a technical event number one. We're also coming off overbought conditions. And despite the fact that this stock had, here, let me go to the live chart so I can measure it for you, KMB. And again, this is going to take aways for any other trade too, even if you're not interested in Kimberly-Clark. So there's T3. Remember, you always sell a little shy. Put your sell limit orders just shy. I give you the actual resistance level where reaction's likely, and you always want to set your sell limit order on a long slightly below. That one we hit a high of 116.82, which is a fractions, probably not even 1%. So that's almost a perfect tag there. And then you can see after that, they stepped in and sold. That was one I did own personally. Took profits, but I'm not re-entering yet. Pulled back. This T2. Remember, resistance once broken becomes support. So they did bounce it, and it could do this, right? Is that objective? Absolutely, all day long. But based on this high-level bearish PPO crossover, here's the last high level and a PPO bearish crossover right there, and you can see what happened. And remember, as much as this stock has had a nice run, and as much as there's a possibility the bear market's over, that's a 25% run in just a matter of a few months. Make no mistake about it. There's no ambiguity here. This stock is in a bear market. This stock has fallen, since that peak back in 2020 right there, 42%. I don't even, I'd have to scroll, go to a longer time frame to see if there was even a higher high. So that is every bit of bear market. There's nothing in this chart that says the bear market's over. And so where I'm going with that is, in a bear market, overbought is usually one and done. It's usually fleeting. You get overbought, and then that's it. And that's the end of the bear market rally. We got overbought right here, and that was the end of that bear market rally. We got overbought here, there. So you can see. So all these things taken together say this stock could have, that may be the end of the run. Now, if it gets back here, the one good thing about it, it's taken out its 200 days, but this stock has a habit of taking out the 200s. See that, and then losing them later on. So all I can tell you is this is even better support. It would be a deeper pullback. And that's it. I don't add much more to it. And there's other things I'd need to see in the chart. Again, to me, it's about just putting the odds in your favor. Having a stock with an attractive risk reward profile. It still pays a nice dividend. And look, if the hammer came down on the stock market next year or two, Kimberly-Clark is going to fall a lot less than Nvidia and SMCI and Micron and SanDisk and all those high flyers. So yeah, typically you're not going to get wiped out. Nice dividend yield. Whatever that is over here. I'm going to move it over. Yeah, nearly 5% dividend yield. So, yeah, not the end of the world if you buy it and it goes down a little bit, but you'd have to manage your stops appropriately. Okay, sorry I had to pause the video there to take a phone call. It's a good 10-minute call. Let me try to collect my thoughts. All right, I think we're over on KMB. All right, anywho, that's that. So, there's still some out in the sector, and overall, like there's some of those that still haven't hit their targets, their additional targets, and so again, still one of my favorite sectors at this point in time. I just think again, we're gonna we shared all the meat off the bone that I wanted to on this one, and we'll revisit that. And same goes for any of the others that I'm looking at. Again, these may be bottoming plays. These are blue chip stocks, and I still maintain what I said before when we started buying these, that you'd see sector rotation, and especially if and when the semis break, which breaks tech and breaks the market, then you're likely to see some real sector rotation. Again, probably the biggest risk to them is just being the economy takes a dive, unemployment starts to go up, and we have clear signs that the economy is turning, a contraction or recession. And then what happens is you get a broad-based sell-off with money coming out of the S&P 500 index funds, and then that puts pressure on all these guys. So as long as we're kind of doing what we've been doing, this zombie-ish kind of economy and sector rotation for a while, these guys still look good. Okay, so let's move on. All right. Questions. We're still working on a couple questions. So that was Kimberly-Clark. Thanks for your thoughts. Okay, this is a new one. I haven't seen this one yet. Yep, just came in 7 minutes ago. Would you kindly share your thoughts regarding picking which month to trade for the futures contracts? For example, I'm looking at NG to go long. Should then G price go up when winter comes? And right now, summer is getting closer. Look, I go with the current contract, the most liquid. If you populate them into your charting platform, just look at the volume or Google what's the current contract, because you have the liquidity there. You go out to you can buy the forward contracts that are beyond the current one. You're going to see lower liquidity, which means then you can use limit orders, try to get in your price. And then you get all kinds of contango and all this backwardization kind of stuff that's just me. I just chart and trade the current contract. So that holds true for index futures or anything like that. So there's my thoughts there. It's too many variables in guessing games is what natural price is going to be. Years ago, I came up with a chart on the seasonality of natural gas, and it worked well for a while. Where obviously, some high demand in the winter starts coming around, especially a colder winter. But then those are the things that happen. Sometimes you have a much warmer than usual winter, or a much hotter than usual summer, and those kind of things can affect the supply and demand. Oh, then you have invasions. Russia invades Ukraine, and natural gas goes crazy. So right now, there's so many moving parts, more so than we've had in recent decades, on especially on energy commodities, oil, natural gas. I mean, just look at Iran and the on off. The strait's open, it's closed. Trump says we have a deal. Oh, Iran says no. Oh, we have peace deal. Oh no, missiles are flying because Israel did this, and now Iran's so guys, I go off the charts because there's just too many variables right now in that. So, and again, on futures contract, I just trade the current contract, and then I'll roll when the roll dates come up. There's all kinds. If you Google futures roll date calendars, there's all types online. You can see what's rolling, when the roll dates are. You can go to filter by type of contracts. This is just one of them. This is investing.com, but there's a bunch of them out there. Okay, let's look at the markets now. So what we're going to do here going forward, we're going to look at three of the major indices. We're going to look at the NASDAQ 100 via QQQ. I've also shared the NQ charts, and if anybody trades futures, I'm going to go over IWM. I believe the majority of traders here trade ETFs. I track them. I look at them both, whether I'm trading the futures or not. Very important to look at the spot or the ETFs, spot ETFs. So we're going to look at QQQ, SPY, and IWM, which recently broke down and triggered a sell signal. And it's already been on a sell signal, but went higher, made a marginal new high. I'll get over that in a second. So remember, if you are around and trying to trade throughout the last few weeks, it's actually been months now. Going back to the beginning of May. Here's May right here, start of May. This is the trading range that the NASDAQ 100's been in. So it's just been going up, down, and we're trading right now today about where we were back here, which is early May, middle May, right there, mid-May, when I draw that horizontal line across. So if you are frustrated because all you trade are the indexes, this is why. So again, open your horizons up. There's a lot of other things out there. It's again a stock picker's market. That's what I mean by that. Where the index, and the same thing with the S&P, are going nowhere. But there's plenty of money to be made. Individual stock picking, commodities. Wheat's been moving lately again after the most recent correction, and the other grains. Miners are still silver, gold are still at that support level, but still look constructive for a potential bounce. Did an extensive coverage on those 2 days ago. That's it. So, okay. So just to recap this, especially for those new to the site, this was a major sell signal, one we were waiting for. It gave us a short entry on QQQ. It's the trend line that comes off the major, very important pivot low, March 30th low. That was the primary uptrend line. It shows very well on the daily chart as well. Very well defined. We went on to quickly hit my first target zone right there. Bounced, and that's it. It's just been going back and forth. The trade's still profitable and has been throughout. We never went negative. We went back to about break even at most. So we're still within even the most aggressive stop, tight stop would still not have been violated. It's just been a dead money trade since after hitting the first target. So now I did give you a sell signal the other day. I was waiting. It was in pre-market. And what happened is they gobbled it right up. We opened up only to come right back above there. And I still maintain that's a very important level. This is just a whipsaw. That's it. And indicative of the holiday trading around the Independence Day holiday. We're still fresh on the heels of that. So I still maintain 705 needs to go. As I like to say, the redder the better, meaning if you have a big intra-period, intra-candle, this is a 60-minute chart. drop below, all the better if you have a solid 60-minute or daily close below the 705 level right there. T1's already been hit once. Doesn't mean that we won't have a bounce if we get there again. And as I've stated repeatedly, any new high anytime soon. Let's just go to the daily chart. We'll zoom in. Here's that same sideways trading range. Should we pop up to any new high anytime soon? Again, the keywords, operative word being anytime soon, it is guaranteed to be a divergent high. Why does that mean? What does that mean? Well, if we go around for all months on end, which is unlikely, or do something else, then these indicators are going to look a little different. But right now, should we pop up soon? The indicators are lagging so severely, the momentum indicators, the PPO and RSI, that will be a divergent high. And again, nothing is guaranteed, but I would say, again, from decades of experience, breakouts that occur with negative divergence and overbought conditions have a very high rate of failure, a rate that I would put well above 80%. So again, play odds. And so that's it. It's not my preferred scenario. And as I often say, I'm not one to give you, oh, the stock market or XYZ or gold or silver could go up or go down. Don't pay anybody for that kind of analysis, if that's all you're getting. My scenario, this is my alternative scenario, but it still has us going down. My preferred scenario, and I'm going to be right or wrong on the trade, but it has us coming down to this 636 level, whether we pop the previous highs first or not. My preference is not that we take out the level I just showed you, the 705, I'm sorry, and then go from there. All right, so there's your update on QQQ. Again, more of the same. And recently got this little trading range here. All right, let's look at SPY, SPY. Same thing, big sloppy. This is still a 60-minute chart, big sloppy sideways trading range. There was the breakdown. Again, when you go to the daily chart, you see it well. And what I'm going to show you here is the primary uptrend lines off the March 30th lows, negative divergence. We had divergence building for a long time, but even on the shorter term frames here, sell signal. We had that little bear flag I pointed out at the time. We perfectly hit that bear flag measured target, and this has been it. This is a sideways, sloppy, go nowhere market. Absolutely, if we can break out and ultimately burn through the divergences, just like QQQ, any new high anytime soon will be a divergent high. Again, that doesn't guarantee a failure. I did not say that it's a 100% failure rate. It's just very high. Again, well north of 80%. And that's what it would look like. So you can just duplicate that and say, divergent high, question mark, and I'll address it if and when it happens. We'll see how things look. I'll look at all the different sectors, the leading stocks, and bonds, interest rates, kind of get an idea of what's going to happen. But as of now, I still favor more downside. And just like QQQ, I think we'll come back. This was these were the multi-month trading ranges. That's what I'm calling for. And QQQ is a back test right now, the top of those trading ranges, which comes in around 696 on SPY, and that would also be a back test, just like QQQ. It would be a back test of the top of its multi-month trading ranges, and then the 200-day moving averages. Okay, and then IWM. IWM is interesting. I haven't covered it in a little while, but we had a nice clean trend line here, also off the key March 30th lows that just recently broke. That's a nice big old bearish rising wedge pattern, complete with your negative divergences there. Breakdown the other day, back test yesterday, and we're still below the trend line there. That puts it on a sell signal. Now, we've already had it on a sell signal. I'm going to give you one new target here. We shorted it, I believe, on that trend line break there. I gave you a total of 1, 2, 3 targets. We hit my first target, just like on QQQ. We hit my first target and we bounced. And it's been a marginal new and still divergent high. In other words, the negative divergences that were in place back here at this high have not been reset or negated, meaning taken through. They've only gotten larger. I'm going to have to just pull this line out here. So we have the same divergences continue to build, meaning you keep making lower lows on the indicators versus back here, and higher highs in price. That is divergence. And So on the 60-minute chart, I have a little more liberal trend line. It's kind of meh because I only have a couple reactions up to this point. This is how I have it on the daily chart right there. And I think that's the better fit. So I'm going to leave that there. I'm going to tweak that trend line because it comes in, it captures both bodies. There's two candlestick bodies, the fat parts right there. The wick or the shadow there below is just an intra-period pop. And then you have, so it's a little bit better to find. And there's the breakdown back test I showed you on the daily. And today I've added a fourth target here down to 258, looking for a test to the top of that gap. If and when we start to get there, I'll let you know if I think we're going to enter and backfill the gap, because this is the bottom of the gap right there. If that fourth target is hit, that's going to be a drop of about 12.5% from where we're at right now. So there's the story on IWM. And again, that's how it looked on the daily right there. And now let's move on to a couple of indicators. Okay, what you're looking at here, let me center it a little bit so you can see it there right up top. Okay, so up on top here, let me box it in. Let me change the color on my draw tool. QQQ is up top. You can see the year breaks down here, 2026, 2025, so forth and so on. So there's the NASDAQ 100 via QQQ. And down below, it's an indicator I've shared with you many times before. This is a what we call a market breadth indicator. It kind of shows you the, lift up the hood. The car might be running. You drove to and from work today. It ran fine, but you get home or you go, I don't know, you pull in a gas station, mechanic checks your hood. He says, man, you don't have hardly any oil in this engine. It could seize up at any minute now, because when your engine's low on oil, it's not lubricating the pistons and all the components moving through there. And then the heat, everything gets hot, and then boom, your engine blows. So that's kind of what we look at in the stock market. On a normal, healthy stock market, especially one that looks like this mega lift here. It's very unusual to have such a strong run, and the majority of stocks, as you're right, we're just fresh off all-time highs, right? We just shorted. We're, as looking at the bigger picture, even though we hit my first target, then we bounced back up. Remember, we almost equaled those highs recently on QQQ. The previous highs fell a little shy. So for all intents and purposes, markets are trading at all-time highs, right? Again, we're just hair off. Yet, I've never seen this in my decades of trading and analyzing charts. And I've highlighted this for a while. The majority of stocks, and I believe it's even worse than the S&P. I have that one. I just haven't queued it up here. Half the stocks in the S&P 500 are trading below their 200 or 50-day moving average, and more than half. Remember, this is the down here, the percentage of stocks in the NASDAQ that are trading above their 200-day moving average. You only have right now 44%. That means 66%. I'm sorry, 56%, over half, are trading below their 200-day moving average, which is extremely unusual. And what happens is, it's not it's not unusual because that's what happens at market tops. The last time, you can see here, what I look at is, in a healthy market, when you get after a nice correction, you want to see the majority of stocks, as they should be, and they were back throughout most points in this bull market, trading above their 200 days. It's this red line I put in the middle. The red line I added at the 50% mark. It's not a default on this platform. If you're going to replicate this, pull up, this is stockcharts.com, $NAA. NAA 200R is the percentage of stocks in the NASDAQ above their 200. And then $NAA 50R is the percentage of stocks in the NASDAQ above their 50-day. And then you can just put a horizontal line at 50, because that's going to tell you 50%. Remember, it's a bounded indicator. The most you could ever have is 0 and 100. You're never going to get to that level. At no point in time are you going to have every stock in the NASDAQ composite trading 100% of them above their 200 days. But you get down to the extremes, and that's where you want to start buying. When you start getting to extremes, and again, I'm going to say what I always say. This is not a timing indicator. This shows conditions. So, just because you get a lot of stocks below their 200 doesn't mean it's time to step in. It was a bear market. There was a hell of a rally right there. We caught it and we traded it long for other reasons. Um, Positive divergence, 60-minute chart, bullish fall and wedge breakouts, pullbacks to support. But then there was another big leg down. But what happened is then you made a higher low. So I look for, just like on my PPO and RSI and a lot of the other indicators I used, I'm big on divergences. So I look at divergences, and all these down here, you can see these lines are negative divergences and some positive divergences. You don't get positive divergences much in a bull market. Bull market, you get corrections. Even COVID, it was a bear market, whatever you want to call it. 36% drop in the S&P, 31 roughly in the NASDAQ. You get these one and done extremes, right? Those are buying opportunities. The good ones come. This was the only real, if you want to call it a real bear market, this was a multi-month, closest looking thing we had to a bear market since 2007 to 2009. And that was the 2022 bear market, where NASDAQ fell about 38% right there. And went throughout most of the year. They really didn't bottom until January of 2023. We had about a double bottom. So it was about about a 1 year bear market. And that one, you did get your nice positive divergence at the bottom. So other than that, big corrections, you look for extreme drops, and you say, hey, things are getting out of control, or a lot of stocks are getting it. You can use it as an oversold reading. But again, this tells a different story. It tells market breadth. In a healthy advance, when COVID hit right there, you had an extreme. But then you had a surge. Most stocks were trading above their 200-day and 50 days. And it led to a nice, prolonged run. But you can see, again, guys, the common theme. The common theme to all these tops, you get the negative divergences. And in every instance, sometimes it takes longer. Look, this divergence started here. No, I'm sorry, it did not. It started, and we only had a little bit right here on the 200. These are two separate indicators, so I look for them on both. But all I can tell you definitively, we've been building divergence since this point right here in early 2023, somewhere around here. And again, it's not as if it didn't matter. Each of these were the biggest corrections. They're getting bigger in magnitude. We had that little drop there. That was about maybe 10, 12% drop. Then about a 26% drop around the beginning of 2025. Again, negative divergence preceding that. And then another divergent high, another drop. That was multi-month drop. But all this is the same divergence, really growing bigger and bigger. So you're getting these corrections along the way. But from my experience, the bigger the divergences get, and these are the same, we have very similar or comparable divergences on the weekly and monthly charts of S&P 500 and NASDAQ 100, the small caps, divergence against the momentum indicators, the PPO, MACD, RSI. So just wanted to point that out. And again, it speaks to what's going on. I mean, I've been saying I sound like a broken record. Others have been saying it. You're seeing just a very unusual and unnatural, in my opinion, dangerous market breadth. Just semis. If you back out, first it was the Mag 8 for most of this period. They attributed the vast majority of gains in the stock market to simply 8 stocks. That's a well-documented thing. It's not just opinion. And then lately, I've showed the Mag 8 have kind of stalled out. Most of them already peaked. And then it's just been single-handedly tech that has lifted the markets, especially the tech-heavy NASDAQ, to new highs. And so, again, say what you want about it. Best case scenario, if I want to be an optimist, I could say that, all right, maybe we'll see, we're already seeing tech. We're on a sell signal on the semis. We're on a sell signal on QQQ. But we're seeing other things, and that's where we're at. Because consumer staples, defensive issue stocks, we're gonna, we can continue to see that, and that is the best case for the stock market. That we get these rolling corrections within certain sectors, but then at the same time, others come in and step in, and you see some buying there. And I cannot sit here and tell you that can't continue for another year or more. Based on this. These are conditions. Analogy I like to use is, ignore that lump on your breast, or that mole that keeps changing color and shape and texture on your skin. Ignore it at your peril, because that could be cancer. And if it is, and the longer you ignore it, the worse it's going to be when it finally manifests. In other words, that melanoma on your skin, once it becomes in situ, or metastatic cancer, then you got a whole other bigger mess going on, right? If you cut it off early or you catch that lump in your breast early, you're going to be fine. But this is what I see here: these conditions that are just being ignored, and they're there. And again, history shows I have 31%, 38%, 13, 30, all the drops: 24, 12, 18, and it would be very unusual to see us burn through and start moving up. But all I can tell you now, again, this period right here, especially with the stocks trading above their 200-day, being below that 50% line, meaning for throughout almost this entire run, the vast majority of stocks they remain below their 200-day. Again, I don't know. I'm just amazed how long this has continued without well, I take that back. I need to be stand corrected here. It has, had some, big healthy corrections and drops along the way. So it's not, again, as if it hasn't played out. It's just unusual. There's not been a reset. A reset, by the way, guys, is when you have like this. You have a bear market. Those divergences build. They build. You had your couple shots across the bow. Then you get a bear market. 38% 1 year washes out, and there's a reset, meaning there's no more divergence at that point because you have price is now lower and we're not continuing to diverge. I'm trying to draw a line. Bear with me here. See, that's not divergence because there was no new high there. That wasn't divergence because there was no new high there. You would have had to go up here. So there was a reset there, and that divergence ended, and you got a nice, healthy advance. Most stocks came up. He briefly came on the 200, but yeah, and that's that's kind of a tell. And it's been this. So, all right, let's move on. One more I wanted to cover with you is the put to call ratio. This is one of, again, many breadth indicators. There's others I could sit here all day long and do a video just dedicated to breadth indicators, but let's look at sentiment indicators. So sentiment indicators, as the name implies, how people feel pretty much. And some of my favorites, one of my favorites is the CPCE, the put to call, equity only put to call ratio. Bear with me, I'm trying to center this for you. Covered it quite a bit. I've had this same chart with these same parameters for years, if not decades. And I've put a line here. The way I use this, there's two things I use on this chart. Number one is this line right here. I put up a 100 period moving average. It's just something I came up with a long time ago by studying the chart, saying, because the thing about put to call ratios, they're going to surge. There's things like holiday trading, corrections, brief things, the invasion of Ukraine from Russia a few years back, the U.S. attacking Iran recently. You'll get, spikes. So to smooth out the bumps, that's what moving averages are good for. So you're looking at the kind of the trend where this put to call buying goes. And the way these indicators work, when it's high, when the put to call ratio is high, there's a lot more put buying than call buying, as the name would imply. Put to call ratio. A put is a bearish bet on the market. It's either an outright bearish bet and again, this is the equity only, strips out indexes. I like that. It's a little more pure because big institutions, commercials will often hedge the indexes. Insurance companies, I used to in my former life as a financial advisor sell variable annuities and other index stock, even the fixed annuities that were the index ones that guarantee you a certain percent of the upside of the stock market capped, but then no downside risk. And the way that the insurance companies do those is they're using puts and, managing, if there's a big crash in the market, they can only lose so much and the policy can, and then the puts pay off. So when you look at the equity only put to call ratio, it's kind of a more pure thing. In my opinion, what folks are doing. And I do look at both. I look at the total put to call ratio as well. And even the index only put to call ratios. And they're all kind of singing the same song. So Years back, I came up with this green zone, and it's not hard. It's just look where the extreme spikes are. And as you can see, and I've shared this with you many times if you've been on following me for a while, at that point, these aren't hard buy signals, but it's look for buy signals, cover shorts, and go long. Okay. So what does that mean? Well, the problem is you can get a spike into there and then you can get another spike into there. But typically, in these circles show where all correction. This is the last real bear market we had, the financial crisis, right? 2007 to '09. Since then, we've had, what you, if you want to call bear markets, like COVID, 36% drop right there in the S&P. We had a 28% roughly bear market in 2022. So again, to me, these are just corrections, right? And in a longer ongoing bull market. But the point is, you can see where they ended. I haven't updated all my little blue circles, but you said you have them here. Boom, boom, boom. And so again, when you spike into this zone, everybody's freaking out. Everyone thinks the world's coming to an end. So the bears are buying puts to short the market, and then longs, people who don't short want to protect their stocks, including institutional traders, will buy puts to limit their downside. And that means everybody's thinks things are going to keep going down and they're afraid. But that's when you want to buy, right? And again, look at my circles. They align with these circles here into the spikes. It's been a extremely accurate indicator and a timing indicator at that. Now, again, I use it in conjunction with buy signals. What does that mean? I'm going to look for at the same time as the stock market and the majority of Mag 8 stocks and the majority of sectors are the important ones, not utilities and REITs. They don't move the needle in the S&P. Tech, financials, those are the two biggest. Are they at support or near support? Do they have positive divergences? Is there a nice clean downtrend line or a horizontal price level to trigger a objective buy point or breakout? Is there a bullish engulfing candlestick or any other type of candlestick bottoming reversal pattern? Is there a selling climax going on at that time with a huge surge in volume with prices plummeting? So there's many, many things when you look for buy signals, and almost always you're going to get them there. And I don't think you're going to find a single time here where we weren't covering shorts and or going long in the markets. All right, so that's the buy zone. Now, the takeaway here is now we're going to the other end. The red zone is extreme complacency. This is where everybody's bullish and all they want to do is buy calls. They're betting stocks are going to go up or they're well, that's pretty much it. It's usually, it's a bullish bet. It can be a hedge too against a short position, but um, and in recent years, what you do is you get these clusters. So you get these persistent periods. These aren't as much as one and done. These were clusters. Don't get me wrong. This was a cluster back here at the end of that bear market. But we've had an identical series of clusters as back here right before. And again, this right here, 2022, once again, is the closest thing that we've had to a real bear market. COVID was a bigger drop in the S&P. It was 36%. But if you blinked, you missed it. And the government came in, not the government, all governments, all central banks, all sovereign governments around the world came in with unprecedented and insane amounts of fiscal and monetary stimulus, meaning zero interest rates, quantitative easing. Um, that's monetary stimulus. Fiscal stimulus is handing checks out to everybody, whether you needed it or not. Coming in, and if you own a business and you were having your best year ever, like most people I know down here in South Florida, we didn't really. Florida was one of the more liberal states with our governor and all that, but that we were walking around and going to restaurants, a week after the shutdowns and going into Home Depot and all that. I remember having to space 6 feet for about a week at Home Depot, and then it was back to normal. My point is, most folks here were having their best year ever, and still, qualified to get, in cases, tens and not hundreds of thousands or even millions of dollars, depending on the size of your business. So that's what we call monetary stimulus. And it was just literally like pouring gasoline on a fire. And so that's what gave us this whole big run up here. But again, So you had this extended period of bullishness, but what you got in that bear market was a reset. You had fear come back in, and so that gave us the fuel. All this, remember, when you get a high put to call ratio, you're also going to have a lot of high short interest. And that gives you fuel for the next bull market. Once you wash out the weak-handed longs, you suck in a lot of bears. That's the catalyst for that. My point is, we've had this whole period here with nothing even close to a reset. A reset is when you get that spike of fear. Fear has left the building and has not returned since the end of 2023, right there, about the beginning of 2024. And we have identical a cluster, if you will, of readings, including a couple recently on the put to call. This is my weekly. I have a daily. I'm not going to, let me move on to what I wanted to cover and then we'll wrap this video up so it wouldn't be too long. But let me just see if I can pull up real quick I've got a lot of different variations of it. Okay, right here you can see this is the daily. I just showed you the weekly. It means every bar on the weekly one is 1 week. But you can see we've been tagging that level. And last time we had a tag right there, we had a correction. The time before that, right there, we had a nice correction. These are double-digit drops, guys. We had a tag here, we had a correction. But what happened? No fear. We're back to it and we've just been tagging it again. So this shows some real extremes. And what happens is when you have this extreme bullishness, what happens is institutions and investors don't have the protection on the floor. So those, when you have, the longer that builds, it sets the stage for a much bigger drop or prolonged bear market, because as you fall, they're not protected and they need to then either sell stocks or buy puts. Okay, moving on. Final charts. We're going to go to just 3 charts. We're almost done here. It should only take a few minutes. We're going to look at SOX, QQQ, and SPY. We're going to look at on one time frame. We're going to look at the weekly time frame, and we're going to look at just one simple indicator. One I've shared many times in the past. It's the PPO histogram. And just if you're not familiar with what that is, or even what a PPO is a momentum indicator. It's a very close cousin to the MACD. MACD's most charting platforms is a very common indicator. Years back, I started using it, and then I gyrated towards its very close cousin. They have a very similar methodology. They look the same on a lot of time frames, but I prefer the PPO. Times I'll look at MACD as well. And there's a lot of useful information you can extract from the PPO, including but not limited to positive and negative divergences, bullish and bearish crossovers in the PPO lines. I'm going to go over that in a second. And bullish and bearish crossovers above the zero line. Those are just some of the few. This is the zero line down here. And so, typically when the PPO is below the zero line, and this is a weekly chart, you're in a bearish trend. That was that 2022 bear market. Again, doesn't look like much, 38% or so, right? The only other time we've spent time below there was right here. And that was certainly whatever you want to call it, whatever label you want to put in. I'm going to measure it out for you. From high to low was about a 44% drop in the SOX. That's what we're looking at first, because I have a couple things marked up on SOX. So, and that one right there, I called it 38. I'm sorry. I thought we were looking at QQQ. This SOX, that was 47%. So in the semis, and again, just so you know, when I use this zero line to delineate trends, I always look at the 9 EMA. That's called the signal line of the PPO, because it's the last of the two to cross. See, so it filters out whipsaws. Right here, you can see the PPO line cross, the blue line, but not the signal line, the white line. So this one, I don't have to change. I use the zero line. It's done a phenomenal job. We're going back into, the left of the chart right here is 2020. Long and strong when you're above there. And when you're above it, a pullback to that level will often act as support. It's only once you break below, again, so if you use the signal lines, the last of two to cross, it says get out of your semis. And again, it's not an exact timing indicator because we're on a weekly time frame. There would have been other sell signals before that, But this was a major trend change, and you were able to sidestep almost the majority of that bear market, that bear trend, because throughout this whole period, right here to here, the PPO signal line was below, and then right here again. And so that was one of the biggest drops there. Now we're comfortably above it now. So this isn't what I'm going to go over, but what I'm going to go over is this histogram, which these green and red bars, they show you the differential or the difference between these two lines. So when the lines cross, you make a bullish or a bearish PPO crossover. There's a bearish PPO crossover. There's a bullish crossover. The histogram is going to cross from red to green, right? Because the closer lines get together, the closer the histogram will approach its zero line. Okay, so that's how it works. And we're going to just squish that down. We're going to squish down the RSI. We don't need it. And again, it's just one of many things I'll factor in. It's not doesn't have a perfect track record, but a pretty damn good one. So again, on a week, and remember this is a weekly chart. So as I don't know if you saw it, but you can see the PPO is clearly headed down. So you don't have to be prophetic, soothsayer to kind of look at the future and say, well, what's this line likely to do? First of all, it's never been this high. I can roll back as long as I want. We've never been this overbought on the PPO. It's never been that high level. It's headed straight down, meaning the momentum was super strong here. It's a momentum indicator, was going up. So the PPO line is clearly headed down. Its signal line is simply a 9 exponential moving average of the PPO line. That's why it responds slower. So again, are there any guarantees? No. But if you're a betting man or woman, would you bet that a crossover is imminent? I think so. It's usually pretty clear. Once momentum stalls and it turns and you head down, you're going to get a crossover, right? These are bearish crossovers. And so that's what I'm going to go. I'm going to go over the bearish crossovers. So let me squish it back down one last time and we'll go through these real quick. So here we are. And again, it's not rocket science. There are no guarantees. It was heading down there, but we weren't close to the zero line at all. We were just coming off really overbought levels, had another punch up, went down. WS means whipsaw. There was a crossover, but it proved to be a whipsaw. So this indicator is not perfect. There are some whipsaws, but if you take it collectively and look at what I like to look at, I call these hills, this is a big green hill, right? This is a big green hill. This is a big green hill. You had one little whipsaw, it was a couple weeks, don't get me wrong, but ultimately we made a crossover that stuck, and then we had a red hill, right? Inverted hill. There's a red hill. So you can see these horizontal lines I put up simply show you they measure right where the PPO cross after. You want to look for it after you've had a big green hill, right? Clear bullish trend. And this one didn't really, it gave you a little blip there. It was pretty much a dead money trade for that's almost a year. Ultimately, then you made a bullish cross back over, and then you had a nice rally. Then you got a flip, you got a sell signal on this. You made a bearish crossover. And again, that was most of that 50-something% drop I just showed you. So just look at the track record again. Just look at the line on the crossover. WS means whipsaw. There was a couple whipsaws. It doesn't mean it can't happen again. But if you look at, you can do the numbers. Take the statistics. Look at how many times it crossed over that it was associated with a drop, usually double-digit drop. Here, 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 here. There was still more to go. And again, remember, we're already short the semis. I gave you, it's an official short trade. We had a sell signal that triggered recently, and it's still short. Every other time that we've crossed over here, I can guarantee if you go back on the site, if I was tracking stocks, then we probably would have had a sell signal via a trend line break or a horizontal support level break or a drop below the 200s or something else. And I just want to show you the pretty much the accuracy. And again, remember, these green hills go in reverse. You look for the bullish crossovers after you're in a bear market, a bear trend. So I'm for simplicity's sake, I just highlighted the bearish crossovers. Why? Because we're already on a green hill. I'm not going to sit here and there's no point in trying to highlight the next bullish crossover because we're already in bullish territory. We have been since right here. And that was the last one right here. It doesn't look like much, but it was a drop of, and I think we had a trade on the semis back then. That was a drop of about 19%. That and it was telegraphed by that bearish PPO crossover. So again, you don't have to be an expert technician to guess which way this is going, because this is momentum. It's kind of like a sports game. Um, you get enough momentum going on a team, and if they're up, World Cup's a great example. The game the U.S. lost last week or earlier this week, whatever it was, where they never had the momentum, and the game was lost. So it's possible to turn it around, but I just wanted to show you that. Now let me just finish the video showing you what the S&P looks like. Marked it up as well. Again, we're just going to keep it very simple. I didn't label the whipsaws as such, but you can see them there. This is COVID. This is what happened with bearish PPO crossovers. This one was, I made a note here. In 2020, this was COVID right here. And remember, we had, again, to say it was unprecedented or excessive stimulus would be a gross understatement. It's just mind boggling the amount of stimulus. So you kind of, you had some whipsaws in there and you had more money injected into the financial system. So kind of get away from using it. That's why you have these whipsaws here. This is where things kind of normalize. The stock market went up over 100% from the bottom of the COVID lows. So that was it. Then we've kind of returned to normal and they started tapering off and the effects took a couple years. So either way, you can see this red big inverted hill correction. Then you had a green bullish crossover, next correction. Wasn't a lot there, but it was also mostly a dead market for a while. It went up a little bit, but not much. Then we had a bearish crossover. It got, signaled you to get out on that correction. Bearish BPO crossover didn't do much there because this is more of a whipsaw. We went up a little, then down, another correction. And so the point is, when you look at these, each and every one, again, it's not a standalone timing indicator. Oh, by the way, I don't use little hill. I like big hills, big inverted hills for bullish crossovers. This is a big inverted hill. These little things here, because it shows you're in whipsawville when you're going through there. Get away from using this indicator. You want these big green hills, these longer trends. Those are the ones when you finally flip and get the signal, you're going to have a decent trend to the downside. Okay, so that's it. So this last one, it wasn't a whipsaw. We certainly, from where we peaked. And remember, this was that sideways trading range I talked about. We went sideways for a while and then ultimately down. We finally broke the downside of the range. And I think in the NASDAQ from high to low was, I think, a 13% drop. And so, again, it wasn't a failed signal. It was just one of the weaker corrections. It was a correction more so in time than in price, but it was a correction in price too. And so it did work. And there's a green hill, and you can see where we're going. And remember, the top almost always comes a little bit before this thing flips. Remember, we already had a sell signal on SPY, QQQ, and SOX based on the trendline breaks off the March 30th lows. So if this flips, it's just going to confirm that we now may be looking at something bigger, maybe even something bigger than my T4 levels on QQQ. And we'll wrap that up with that. Go to QQQ, the weekly chart. Again, post-COVID kind of and low little back and forth. But even with COVID, you can see we had green. It was quick, but we dropped down, and that was that 36% drop in the S&P. NASDAQ fell a little bit less, I think 31. And then we finally had a crossover that mattered. Big red hill. Had a little bear market rally marked by the green bullish crossover. Then you flip back again. There was more downside. The NASDAQ stayed flat, didn't bottom until right in the beginning of 2023. And you got a cross before that. And we were long and strong there. Highlighted the Mag 8 as my top picks. And even within there, gave you Apple, Amazon, a couple others as my favorites. And that's where we were all in long, based on not just this positive divergence, everything else was set up in the charts. And then we took back the 200-day moving averages. You can see we bounced. So either way, big green hill, bearish crossover here. Nice correction, multi-month. Again, this is a weekly chart. These are weekly candles. That's a multi-month drop signaled by the bearish PPO crossover. Oops, I got to move that over one notch. Nope, missed it. Right there. There was the crossover. It's not letting me center it. You guys, okay, you figured it. You can get it. Another drop again. Might not have been double digits close to it. Another drop there. Bearish crossover there. Big drop in early 2025. And then right here, again, that was, I think, 13%. We hit the T1 right there, first target on the daily chart. That's when we reversed. And here's where we're at now. So again, looking at the rate of descent on the histogram, it's coming down pretty fast. I mean, it's like throwing a rock into the air. You know, it stays, you know, goes up. There's acceleration to the point of deceleration, and then it's for a split second it stops. It's not going up or down, and then you go down. This was a little bit more gradual because it was a more steady, normal incline in the Nasdaq. So that's why it came down at this rate. It's the sharp ones like this that give you the sharper drops. Okay, guys, that's all I wanted to cover in this video. As I said in the beginning, I will start to turn my focus either tomorrow or over the weekend into hunting and finding some new trade ideas now that we have a lot that we've been, you know, either at or close to final targets. And we'll see what else I can get out for you. So this is just kind of general broad market stuff. And remember, these are things I talk about from time to time often, and especially on the weekly chart, they just don't have that timing element involved. If you want to get a little hyper focused, you know, that was a sell signal there, still waiting for a break. Like I said, I jumped the gun getting that pre-market post out, but whatever, I don't regret it. It was an objective short entry. I thought we'd get rejected there. We're back into the range, but nothing technically significant. You turn off all the lines. It's not it's a sideways range mostly because you have lower highs, but you also have higher. Well, that low the other day was a new low by a hair. Again, let's not get, you know, too deep into it. It's noise, it's chop and slop. So this is the bottom of the bigger range. This is that 710 level I said needs to go. And obviously, once the bottom of the range clearly goes here, T1 really, remember we already hit it, then that opens the door for these guys. And I truly believe it'll be a quick ride down if and when we get it, because the more you do this, it's energy building like a coiled spring. When you finally break from one of these ranges, it's usually a pretty quick move. And I'm still favoring this downside break ultimately, even if it comes with an upside whipsaw first. All right. And if something changes, I'll let you know. If this doesn't play out, it's not going to hurt me because I don't have all my money in the NASDAQ 100 NQ future short right now. You know, I'm spreading my bets, and that's what we're going to continue to do. So let me wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.